Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're talking about a company that has literally been shaping the world since Abraham Lincoln was in office. Corning Incorporated, ticker GLW.
175 years of bending light and bending glass. And right now, they might be having the best year of their entire existence.
We're talking a stock that's roughly quadrupled off its 52-week low, a $6 billion deal with Meta, and a company that's gone from making Thomas Edison's light bulb glass to becoming the nervous system of artificial intelligence.
There's a lot to unpack. Let's see if the fundamentals match the hype.
This is episode 134, Corning Incorporated. Let's get into it. So Corning, founded in 1851, headquartered in Corning, New York, a town that literally exists because of this company. They operate across 5 major segments, and I think most people only know about 1 or 2 of them.
Right. Most consumers know Gorilla Glass, that ultra-tough cover glass on basically every premium smartphone. Corning commands over 80% market share in that space, and their proprietary ion exchange process makes it essentially irreplaceable.
But the real story right now is optical communications. Corning manufactures the fiber optic cables and connectivity hardware that makes the internet work. And with AI data centers exploding, that segment is on fire. The Gorilla Glass business alone is fascinating. They've shipped it on over 9 billion devices worldwide. When you pick up your phone, your laptop, your tablet, there's a very good chance you're touching Corning glass.
And they keep iterating on it. The latest versions are designed for foldable phones, Gorilla Glass Ceramic, which opens up entirely new form factors in consumer electronics and even automotive displays.
The pharmaceutical packaging angle is interesting too. They announced a deal to acquire Gerresheimer's glass tubing business for about 96 million euros, expected to close by year-end 2026. That market is growing nearly 5% annually.
Their Valor Glass technology for drug vials has been gaining traction with pharmaceutical companies. The idea is that traditional glass vials can cause contamination issues. Corning's specialty glass reduces that risk significantly.
One thing I love about their springboard plan is how transparent they've been about the milestones. They set a target, beat it, and then raise it. That kind of execution builds real credibility with institutional investors.
And looking at the forward estimates, analysts project revenue climbing to about $18.7 billion in 2026, then $21.4 billion in 2027, and potentially $24.7 billion by 2028. EPS estimates follow a similar trajectory, from $3.11 this year to nearly $4.83 cents by 2028.
At OFC 2026 in March, they unveiled some genuinely impressive technology, a 32-fiber connector that doubles the density in tight spaces, plus co-packaged optics that bring fiber directly to the chip. That's the kind of innovation that keeps them ahead.
The co-packaged optics technology is particularly significant because it addresses the bandwidth and energy efficiency challenges that hyperscalers are facing as AI workloads scale up. It's not just incremental improvement, it's architectural change. They also have environmental technologies. Think ceramic substrates for automotive emissions control, a life sciences division selling lab equipment and specialty glass for pharmaceutical packaging, and the display technologies segment making glass substrates for TVs, monitors, and OLED panels.
5 segments, 56,300 employees, roughly $146 billion market cap as of today. That's a big diversified material science company.
And the diversification matters because when one segment slows, like displays have recently, the others can carry the weight. That's exactly what's happening now, with optical communications leading the charge.
The man running the show is Wendell Weeks, and he's been CEO since 2005. That's 21 years in the chair. He joined Corning back in 1983, so we're talking over 4 decades with this company.
Weeks is one of the more interesting CEOs in the S&P 500. He reportedly spends 40% of his time in R&D labs working alongside engineers. He actually holds multiple patents himself. Jeff Bezos once said Weeks was deeply shaped by Corning's near-death experience during the early 2000s telecom bust.
He added the president title in October 2025, so he now holds CEO, chairman, and president, all 3 roles. His leadership style is described as low-key and humble, but people who work with him say he's intensely focused when solving problems. All right, let's dig into the financials. Starting with valuation, Corning's trading around $169.80 a share with a market cap of about $145.7 billion.
The trailing PE sits at roughly 91 times earnings. That's eye-popping. But context matters. Corning had a weak Q1 2025 that dragged down trailing EPS to about $1.86 for the last 4 quarters. Forward PE based on 2026 consensus of $3.11 comes out closer to 55 times. Still not cheap.
Price to sales is 9.3 times, price to book at 12.4, and EV to EBITDA at 22.5 times. These are premium multiples across the board.
TTM revenue stands at $15.63 billion, with gross margins of 35.9% and operating margins at 14.7%. But the trajectory matters more than the snapshot. Q4 2025 operating margins hit 20.2%, which was ahead of their own target.
Net margin runs at 10.2% TTM. Return on equity is 13.5% and return on assets at 5.2%.
Cash flow picture looks solid. Operating cash flow in Q4 2025 alone was over $1 billion. TTM free cash flow comes in at roughly $1.41 billion. The company is generating meaningful cash to reinvest in capacity expansion.
On the balance sheet side, Corning holds about $0.53 billion in cash against $10.2 billion in total debt. Net debt stands at $8.7 billion, giving a net debt to EBITDA ratio of 2.3 times.
That debt load deserves attention. The current ratio is 1.59 and quick ratio at 1.04, so short-term liquidity looks fine. But $93 million in quarterly interest expense adds up. At these growth rates, the debt is manageable, but if growth stalls, that leverage becomes a concern.
So what's the health verdict?
Growing revenue, expanding margins, strong cash generation, but carrying meaningful debt and trading at premium valuations that assume continued execution. The fundamentals are improving, but the stock price has priced in a lot of that improvement already.
The street is broadly bullish. We've got 23 buy ratings, 5 holds, and 0 sells. Consensus is strong buy.
The average price target sits around $139.80, which is actually below where the stock trades today, near $170. That tells you the stock has run past what most analysts predicted. Recent grades are all maintains, BofA and Citi at buy, Morgan Stanley at equal weight, UBS at buy, JP Morgan at overweight.
Last earnings on January 28th came in at 72 cents per share versus the 70.7 cent estimate, a beat. Revenue hit $441 billion versus the $436 billion consensus.
And looking ahead, Q1 2026 reports May 5th. The street expects 68 cents on about $429 billion in revenue. Corning guided to 15% year-over-year sales growth and 26% EPS growth for Q1. That's the number to watch.
Let me lay out the bull case here, because it's a compelling one. First and foremost, the AI data center build-out is creating a once-in-a-generation demand wave for fiber optics, and Corning is the clear leader.
The Meta deal puts a fine point on it, up to $6 billion for data center connectivity. With Corning expanding its Hickory, North Carolina manufacturing facility, that's not a one-quarter pop, that's multi-year revenue visibility.
Second, the Springboard plan keeps getting upgraded. It started at $4 billion in incremental annualized sales. Now it's targeting $570 billion by end of 2026 and $11 billion by 2028. Management is consistently beating their own targets.
Third, operating margins hit 20.2% in Q4, proving this isn't just revenue growth, it's profitable growth with real operating leverage.
And those competitive moats are deep. Vertical integration in fiber, 80+% share in Gorilla Glass, over 11,000 patents, and a fusion draw manufacturing process that's nearly impossible to replicate.
Now let me give you the bear case. The most obvious risk, this stock surged roughly 65% in 4 months. At 91 times trailing earnings, there's very little room for disappointment.
What else worries you?
The debt, $10.2 billion total, with net debt to EBITDA at 2.3 times. If interest rates stay elevated, that eats into cash flow. Also, the AI capex cycle is the key assumption here. If hyperscalers pull back spending because AI returns disappoint, Corning's optical segment would feel it immediately.
The display segment is also soft, with panel makers cutting utilization rates.
And there's customer concentration risk. The Meta deal is transformative, but it also means a meaningful chunk of future revenue depends on one hyperscaler's priorities. If Meta shifts focus, that's a real vulnerability.
Let's see how Corning stacks up against peers. We're comparing against TE Connectivity, Keysight Technologies, and Motorola Solutions.
TE Connectivity trades at about 26.5 times earnings, with a PS of 4.2 and 8% revenue growth. Keysight is at 35 times earnings, 8.5 PS growing 12%. Motorola Solutions sits at 38 times PE, 6.8 PS growing 10%.
Corning's PE at 91 trailing is well above all of them, though the forward PE of 55 narrows the gap somewhat.
The premium is justified only if you believe the AI-driven growth trajectory is sustainable and differentiated. On a forward basis, the valuation gap shrinks meaningfully, but Corning still commands a premium to the group.
In the options market, the tone has been bullish. We saw about 8,400 call contracts trade in early April, which was 1.7 times higher than normal volume.
The elevated call-to-put ratio and rising implied volatility suggest the options market is pricing in continued movement ahead of Q1 earnings on May 5th. Traders seem to be positioning for more upside.
On the insider front, CEO Wendell Weeks received about 30,900 RSUs as compensation in early 2026. We did see some selling from the CFO and other executives during the stock's surge in January and February.
That kind of profit-taking after a major run is normal and not necessarily a red flag. The company still has a $5 billion share repurchase authorization in place, with about $1.8 billion already deployed through Q3 2025.
Key risks to watch. The duration of the AI CapEx cycle is number one. If hyperscaler spending slows, Corning's optical segment takes the hit.
Debt service costs are climbing, $93 million per quarter in interest expense on that $10.2 billion debt load. The display segment faces continued headwinds from panel maker utilization cuts.
Execution risk on their $1.7 billion CapEx plan for 2026 is real. They need to expand capacity while maintaining those improving margins.
And there's regulatory exposure, a $92 million charge from a South Korean tax dispute, plus $525 million in unrecognized tax benefits that could create future cash flow surprises.
So here's where we net out. Corning is riding the most powerful demand wave in its 175-year history. AI infrastructure has transformed them from a cyclical materials company into a critical enabler of hyperscaler connectivity.
The Springboard plan is delivering ahead of schedule, margins are expanding, and the Meta deal provides years of revenue visibility. The question isn't whether Corning is a good business, it clearly is. The question is whether the current price already reflects that.
The key metric to watch is Springboard progress. They're targeting $5.75 billion in incremental annualized sales by end of 2026, with $11 billion by 2028. If they keep hitting those targets, the premium valuation has support. I want to leave you with something Wendell Weeks said that I think captures the ethos of this company. He said, if you're going to sustain as an institution, you have to focus on problems that matter. A company's value is ultimately measured by whether or not it does good in society.
For a guy running a 175-year-old glass company that's now powering AI infrastructure, I'd say he's putting his money where his mouth is.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. That's going to do it for episode 134, Corning Incorporated, ticker GLW. Thanks for listening to Charged Alpha. We'll catch you on the next one.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.